Hello everyone, this is the course on principles of behavioral economics and I am going to discuss policy implications of mental accounting. So, in this lecture, lecture 39 and also the next one, lecture 40, we are going to conclude mental accounting after discussing the policy implications. Now, while discussing the policy implications, you would realize that a large number of examples or instances we have already discussed in some other context. Nevertheless, here we are going to talk about the policy implications of those instances. So, we will definitely refer to the previous topics that have already been discussed. So, in the discussion on mental accounting, we have concentrated largely on examining the neoclassical model behavior of individuals, particularly consumers. This behavior has important implications for the behavior of institutions such as firms and governments and for markets. It is generally assumed here that these institutions respond rationally to the non-neoclassical behavior of individuals with certain exceptions. Now, it is important to note that mental accounting addresses the non-neoclassical behaviors of primarily individuals, while we are claiming that firms, government agencies, they mostly behave in a more rational way. So, why it is so? A key difference is experience. Firms tend to be specialized, have access to large amounts of data and have the ability to analyze it more effectively. They are also subject to competition, so that firms that do not respond appropriately tend to be driven out of the market. So, the chances of making mistakes, in the sense making not so rational decisions, can lead to devastating results for firms or for any entities that are competing with several other competitors. So, as a result of which they have to be more deliberate and careful in their decision making. Even when firms do have biases that cause non-standard behavior, in particular the principal agent problem, they still have incentives to respond to the non-standard behavior of consumers. The same applies to employers, financial institutions and politicians when they respond to the non-neoclassical behavior of workers, savers and investors and voters. So, broadly we would see more of not so rational behavior among individuals classified as workers, savers, investors and voters, while the other parties facing more competition, having more experiences, would generally be more careful in their decision making. The responses of 5 main categories will be discussed. They are individual agents, of course, marketers, labor markets, financial markets and government policy. So, we begin with individual agents and we will conclude this module with discussions up to marketers. So, one major implication is that people should allocate expenses to unambiguous categories to avoid overspending. People are more likely to spend if there is ambiguity in the categories used. An extreme example of such a self-control device is where cash is placed in labeled envelopes for specific uses. So, for example, in the very beginning probably I mentioned or while discussing fungibility that in an earlier time when there used to be more cash transactions, then people used to actually keep separate money separately in separate envelopes earmarked for groceries, for children education, for vegetables and so on. There are also implications here for gift giving. We have seen that people may be delighted to receive a gift that they would never buy for themselves, being outside their budget for that category of expenditure. So, these are the anomalies that we have observed. Another type of self-control device for consumption relates to the restriction of cash withdrawals from banks or ATMs to small amounts. So, this is what we talked about in the context of denomination effect. This may be an effective commitment if there is no opportunity to withdraw more cash in the near future. In a similar manner, consumers may limit their purchases to small amounts. So, all these are instances where we try to exercise some kind of self-control. Smokers may buy packs of 10 cigarettes for example, which again may be an effective commitment if there is no opportunity or if it is inconvenient to buy further cigarettes later. In any case, if you do not have the things readily available with you when you are actually getting an extreme desire for smoking, then of course there could be inconvenience, but nevertheless that reduces your consumption. So, if you buy in smaller batches, that is another instance of self control. This last example is interesting because it violates two economic principles. First, it is normally cheaper to buy most goods in larger quantities. Second, it contradicts a principle of prospect theory described earlier, that losses should be aggregated because of diminishing marginal sensitivity. But here we observe that the losses should be aggregated. So, integrate the losses, but here basically segregating the losses actually helps, as we discussed previously, that see in 365 days one individual spends say nearly, or I would say in 12 months, every month someone is spending 3,000 on cigarettes. So, in 12 months he would be spending 36,000. So, 36,000 is actually a large amount, but you bring it down to per day consumption, then it becomes much smaller. So, as a result of which here we can see that losses are being segregated, that drives consumption. There are other instances also when some such things happen. Another area of behavior where commitment may be beneficial for consumers is when prepayment for a good or service is possible. There is experimental evidence that prepayment can increase commitment to prepaid options and also increase motivation and engagement in relevant tasks. There are also policy implications regarding time budgeting. Again, people may budget time into different categories for self control reasons. An author, for example, may have a time budget related to writing 5 pages a day. Other tasks such as doing housework, repairing the table or paying a bill may be foregone in achieving this target. So, of course, there would be some drawbacks associated with achieving this target. Nevertheless, in order to what is you basically you prioritize. So, things which are more important needs to be given more attention. So, if you really focus on completing writing or a write up, then you have to, whatever you are writing, it could be a novel, it could be a story, it could be a piece to be published somewhere, then in that case you can always set deadlines that you must write at least 5 pages a day in order to complete it within the stipulated time. So, this is what this is another example of self control. So, next we talk about marketers. We will focus on the following most important policy implications, because there are huge amount of policy implications when it comes to marketers, specifically from the perspective of mental accounting. As in the beginning we mentioned that mental accounting has substantial applications in the field of marketing. So, it is not possible or outside the scope of this course to talk about all of them in detail. So, we specifically focus on 5 aspects: sales, promotion, free offers, bundling, disaggregated pricing, pricing structure, cash versus credit cards, trade-in pricing. As you can understand that some of the things have already been discussed. Now, we are looking at it. So, there are 2 things. One is somewhat summarizing and looking at it from the policy perspectives, in the sense when there are observations related to mental accounting, then how marketers can exploit it, utilize it or manipulate it towards their advantage. So, beginning with sales promotion, the concept of hedonic editing has important implications in this area of strategy. Researchers used 3 different types of promotions of the same monetary value to assess the applications of mental accounting. They are extra product promotion, where an additional amount of the product is provided at the same price. For example, many times you would see that in a shampoo bottle there would be 20% extra. This happens with many products. So, they would increase the size by 10% extra, 20% extra. Second one is price of promotion, a temporary price reduction below the regular price is given, which is also very common. All of us are familiar with that. We get price discounts like 20% discounts, 30% discounts and so on. And finally, premium promotion, a separate complementary product is provided for free. Now, the first method does not segregate gains, since the gain is in the same form as the product bought. So, in the first method is that we are providing some extra amount of the same product, as like 20% extra shampoo is in the same bottle. Now, this is difficult here in this context, it is difficult to segregate gains because the gain is in the same form as the product bought, whereas the other two methods do segregate gains, with the gain from the promotion being either monetary, that is in the second case where we are getting a discount, or in the form of a complementary product, that is the third case when an additional product is given with the main product. Thus, the last two methods were supportive of the hedonic editing hypothesis and could be more effective or effectively utilized by the marketers. Price promotions involve several psychological processes on the part of the consumer, with implications for marketing that are often counterintuitive. For example, it may be better to offer no discount than a low discount in some circumstances. A zero discount may become a reference point, being regarded as a normal price, that is the product is sold at a regular price, but a low discount of say just 5% may be compared with a higher discount being a reference point. Now, higher discount offered previously or maybe in competing products. If some competing products are offering higher discounts, then you have a reference point. Thus, a low discount may yield a low transaction utility and result in lower sales than a zero discount. You could be quite okay in buying the product at MRP because not all brands offer discounts. But then when a very small discount is offered, then you have a reference point and that may discourage you to purchase the product at a smaller discount. Consumers may either buy elsewhere or wait expecting a larger discount in the future. So, either you are expecting a larger discount in the same product or on the same product, or you would be going for competing product close substitute of it having or offering a larger discount. A number of studies have indicated that multiple discounts may be more effective than a single one amounting to the same thing, which could be thought of as segregation of gains. See, this is very common with e-commerce websites. You can see that in most of the e-commerce platforms, there are always additional coupons on top of the existing discount. Some products are sold at 30% discount. You are asked to go for another coupons which will give you another 10%, 20%, whatever amount of discounts. So, here your gains are segregated and it has been observed that is why that multiple discounts may be more effective than a single one, and the reasons are there may be other reasons for consumers preferring a multiple discount, other reasons other than segregating gains. Segregating gains is definitely there. Beside that, for example, 20% off plus another 25% off rather than an equivalent 40% off. So, many times this 20 plus 25% off is perceived to be 45% off. At times you can also see that 50% off plus 40% off. One may quickly think it is to be 90% off, but this is actually just 70% off. One reason is the face value effect. So, we call this face value effect, meaning that consumers wrongly perceive the first offer as amounting to a total of 45% off instead of the actual 40% off. So, this is how consumers, the marketers can perceive the consumers at the same time or along with having the impact of segregation of gains when there are multiple discounts. Another reason is that consumers may perceive a multiple discount regardless of the percentages involved as being a rare offer. A fundamental psychological insight is that consumers value rarity or scarcity and are prepared to pay more for products that they perceive as being scarce. However, in today's time when there are so many e-commerce platforms, almost all of them are always going for multiple discounts. The multiple discount concept is not actually rare offer, but still in the offline shops you would find multiple discounts generally not so common. They go for a flat rate discount on products and most often, not most commonly, multiple discounts. So, from that perspective, in the offline market multiple discounts can still be rare. Thus, limited offers where either the amount of the product on sale or the time period of the offer are limited tend to increase sales. Emotions also play an important role in determining how consumers react to price promotions. Transaction utility increases cognitive ease, which results in an increase in the importance of visceral or emotional factors as cognitive load is reduced. Studies reported that this influences behavior when consumers are faced with a choice between two snacks, one with greater cognitive appeal and one with greater affective or emotional appeal. The authors find that, as predicted, a 50% discount on both snacks causes a switch in preference from the former, that is the product with cognitive appeal, to the latter, that is the product with greater affective or emotional appeal, compared with when both snacks are at full price. Next we talk about free offers. There appears to be an ever increasing tendency for firms to offer goods and in particular services for free. Such a strategy is more effective at increasing sales or usage of hedonic rather than utilitarian products. So, products of pleasure or enjoyment as compared to utilitarian products implies products which are more practical, necessity based. In many cases, free offers are combined with other required goods and are often termed freebies. There appears to be conflicting evidence regarding the effectiveness of this kind of strategy when we are getting freebies or when there are free offers. This kind of offer decreases the price that consumers were willing to pay for each product in the bundle when sold individually. Consumers seemed to react to such bundles by not only regarding the freebies as being of low quality, but by regarding the other products as being of lower quality as well. So, when there are freebies, interestingly, not only the free product is assumed to be or thought of being of lower quality, at times the original product is also thought of being of lower quality. That is why you are giving offer or clubbing offer with it in order to incentivize the consumers to go for those products. Thus, this kind of promotion could have a long term damaging effect on overall sales. However, other studies have found that consumers may have a higher willingness to pay for the product after the promotion is retracted when it was offered for free than when it was offered at a low or discounted price. The reason once again is related to reference points. Consumers may regard the discounted price as a reference point, inferring a low quality product. However, they are less likely to do so for free offers. Instead, they use the price of the focal purchase as an anchor to make inferences about the quality of the freebie. So, focal purchase is basically the good that you actually intend to buy, and the freebie is coming as a thing which is completely free of cost. So, what happens is that the consumers are less likely to go for or inferring a low quality product for free offers. Instead, they use the price of the focal purchase as an anchor to make inferences about the quality of the freebie. So, if the focal purchase is actually perceived to be of good quality, having higher prices, then the freebie is possibly not considered to be of low quality. Otherwise, that is a possibility. The third thing that we talk about is bundling. The free offers involve a particular type of bundling, but in more general terms, bundling occurs whenever two or more products are sold as a single package. So, freebies are one kind of bundling. There are basically two alternative pricing strategies here: consolidated pricing and partitioned pricing. Taylor recommends consolidated prices based on the mental accounting principle of aggregating losses when there are evidence in support of partitioned prices as well, thereby segregating losses, where the consumer may be prepared to pay say $92 plus $5 shipping, but not a total of $97. So, when the consumers are willing to accept a price of $92 and of course are also willing to pay a shipping of $5, but they find that a price of $97 is overpriced. So, basically when you are clubbing the shipping and the price together, then consumers may not like a higher price. So, this is a case of consolidated prices when basically when we are aggregating losses, then there is evidence in support of partition prices. So, basically it suggests that we should rather segregate losses. Here partition prices are more relevant. However, it may only apply to hedonic goods but not utilitarian goods, on the basis that people are more inclined to ignore unfavorable information with hedonic goods and thus not pay attention to surcharges that may cause negative feelings. Basically, when we plan to buy or consider buying hedonic goods and services, then that is more driven by our concept of individual or objective pleasure and enjoyment. So, since, or rather I would say subjective pleasure and enjoyment. So, since these concepts are very much subjective, so we may not consider how others felt about that particular good or service. So, we pay less attention to surcharges that may cause negative feelings. Basically, the transaction utility is lower in this case, or negative transaction utility is lower in this case. On the other hand, following Kahneman and Tversky's notion that prices are legitimate exchange for value received, prices do not merely represent a cost or loss, they can also be viewed as a proxy for benefit. So, basically when I am paying a price, I have already discussed this concept, then this is not considered as a cost or loss, rather in exchange for the benefit I am willing to pay something, and this is the price of the benefit. So, alternatively a proxy for a benefit. With this in mind, price partitioning may segregate losses, reducing consumer evaluations, but at the same time it may segregate gains, improving evaluations. So, there are now two things at work. When we are going for price partitioning, then we are basically, the loss component is segregated, but in against the prices or against the prices paid, we are receiving certain goods and services. So, they are the benefits. If the benefits are aggregated, then of course, there is the two evaluations working in opposite direction. Now, which one dominates would decide whether you would be paying for that particular commodity, goods or services or not. So, therefore, price partitioning may have a net effect on evaluations, that is either good or bad depending on the circumstances. If partitioning or segregating the losses exceed integrating the gains, then consumers will not buy it. If partitioning is less than, or segregating the losses is less than integrating the gains, then consumers are going to go buy the goods or service. Various studies examining the circumstances which may influence overall consumer evaluations of product bundles show that mental classification of goods into different categories like expensive versus inexpensive can play an important role and lead to the anomaly that people may be prepared to pay more for an expensive item alone than for the expensive item bundled together with an inexpensive one. This anomaly suggests that the inexpensive product is actually detracting from the value of the expensive one. It is reducing the value of the expensive one. There are different possible explanations for this. It may be that the bundling of the product suggests that the expensive good is of lower quality, or it may be that the high price of the expensive product on its own is suggesting a higher quality. For complementary products, it is observed that though partitioning raises the salience of the price of the components, but it also differentially raises the salience of different aspects of the product depending on the component that is partitioned. So, of course, when we go for partitioning, then we are actually suggesting salience. Things are segregated, so each and every component now becomes prominent, visible and salient to us. So, it might have again varied impact on a consumer's decision making. For example, in an experiment with refrigerators bundled with ice makers and a warranty, the ice maker is a consumption related accessory while the warranty is a performance related accessory. Partitioning both the ice maker and the warranty significantly improved consumer evaluations, but the effect was greater with the consumption related accessory. So, when basically they were partitioning, that is segregating the prices, then what happened is that it improved consumers evaluations, and it was observed to improve consumers evaluations, and that was more with consumption related accessory, that is for the ice maker. So, improved evaluations in the sense that evaluations went in favor of that particular commodity. Another example of a situation where salience is important is bundle promotions, where consumers receive a discount when they buy a certain number of units. However, it is observed that the main effect was actually to cause brand switching, maybe because the purchase quantity requirement was often too high to cause consumers to buy much more of the same product, but the salience of the product caused by the promotion induced brand switching. So, this is another interesting observation, that it actually led to brand switching, that is, people moved from one brand to another brand. So, consumers tend to set a budgets in different categories, but also tend to have a petty cash category to cover miscellaneous small expenses, which we have already discussed, that firms can take advantage of this aspect of mental accounting by disaggregating prices, particularly for services or consumer durables. A common marketing ploy for selling relatively expensive durables and services is to express the price in terms of an amount per day. Thus, a $500 per year health club membership might be expressed as less than $10 per week or only 1.37 per dollar. So, this is to incentivize consumers to go for such purchases. Now, these days if you go to Amazon website, you would see that suppose you plan to buy a dishwasher for 30,000 rupees, but you would see that something is written in a much larger font, say 10,000 rupees and then per month. So, basically this is the EMI that they are suggesting to go for. So, if you say go for a 3-month EMI, then you would be paying roughly say 10,000 rupees per month, and below it the actual price of the product is written as 30,000 rupees. So, the point is that at first you would think that a dishwasher is available for 10,000 rupees a month, but then you would realize that this is basically the total price broken into 3 months. The total price can be broken into 6 months, 12 months, 24 months also. So, as a result of which, when this per month amount becomes smaller and smaller, so even those individuals who are not able to purchase a 30,000 rupees product at one go may consider buying them. So, again here we are segregating the losses. Next we talk about pricing structure. We have discussed that flat rate bias, where consumers often prefer to pay flat rates for products like cellular phone services. This has already been discussed. However, firms often take advantage of a non-neoclassical feature of consumer beliefs, which is overconfidence. People tend to underestimate their usage of recreational goods like phone and internet service, and also are overconfident regarding the precision of their demand forecasts. Firms can take advantage of this by offering tariffs with included quantities at zero marginal cost, for example free minutes, followed by steep marginal charges. So, these days also we can actually see this kind of things, the kind of whenever we go for different kind of service packs for our mobile phones, you have say 2 GB data per day, 3 GB data per day, but when you exceed the limit, then there is steep marginal charges. So, to certain extent it is actually free minutes. So, zero marginal cost till the time you basically reach the limit, but then when you exceed the limit, then there is steep marginal charges. So, most often we feel confidence about the fact that I am not going to use more than 2 GB or 3 GB per day. But then if firms understand that there are possibilities, then of course they would be benefiting financially tremendously. Similarly, in rental markets, firms can charge moderate flat rates combined with large late fees. The sixth perspective is, or dimension is of cash versus credit cards. We have discussed that people may prefer credit cards over cash due to the effects of salience, payment decoupling, and the greater feeling of loss when paying by cash. However, there is a flip side to this in terms of the post transaction situation. Studies reported that post transaction connection is greater when payment is made by cash, resulting in greater emotional attachment to the product, a greater commitment to the seller, and a greater brand loyalty in terms of a higher likelihood of repeat purchase. So, since the transaction when in terms of cash is salient, then the advantages are also from the emotional perspective, that in our mind also it leaves a more impactful impression the transaction overall becomes salient, the losses are salient, the gains are also salient. The psychological mechanism here may involve cognitive dissonance in that, like the disposition effect, people may be more reluctant to admit that a cash purchase was a mistake than a credit card purchase. Since you have greater emotional attachment, accepting that it was a mistake is also more difficult. Thus, a company relying heavily on credit card purchases may make more sales initially, but may also have more fickle customers, because since there is no commitment, the customers may not feel like coming back repeatedly. Of course, there are other factors which compel the customers or induce the customers to go for repeat purchases, that is of course brand loyalty, and there are many other things, but then this is one situation where it is possible that credit card transactions, since they are not salient, that is why they fail to come up with a lasting impression on the consumers in terms of the product's impression. In the context of sunk cost, it is seen that people place more value or importance on the good being traded in than the good being purchased. By taking advantage of this, car dealers are observed to give a customer more for their trade in than they actually are. So, for example, if I am returning my or selling of my old car in lieu of a new car, then this is one example of trade in. So, they would actually inflate the price of my old car, saying that I am going to give you a discount of say 2 lakh rupees, or I am going to offer a price of 2 lakh rupees, while I think that the I mean that would of course make me happy, but actually they might be giving me a discount of 1.5 lakh only. So, they do this by artificially inflating the price of the car being purchased and then artificially inflating the trade-in allowance. Consequently, some car buying guides and public policy makers advise car buyers to keep the two transactions separate and to agree on the price of the new car before negotiating a trade-in price. So, with this I conclude this module. We will continue with our discussions on the policy implications of mental accounting in the next module as well, where we will discuss labour markets and government policies. Thank you.